stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Zacks Director of Research, Sheraz Mian, who is also the editor of Zacks' most fun and exciting portfolio, our best one, Zacks Top 10 Stocks. It's 10 stocks that are released in the first week of January every year, and then they're held for the full year. Now, this portfolio is always shrouded in mystery. None of us know what's going to be in it because Sheraz keeps his new picks a secret until the launch. And this coming year, the launch date is on January 3rd. So all of us have to wait until January 3rd to see what's in this top 10. And believe me, I'm always tuning in on the day it launches to find out what's in there. So this year's top 10 has been another barn burner. And through November 30th, this year's top 10 has returned 36.1% versus the S&P 500 at 25%. And so it's been red hot with a couple big winners in there. So Sheraz, there's a lot of pressure on you. You got a lot
That's right.
live up to, given 2021's portfolio and the prior years have done well as well. So
Sure.
It's just like building year after year. But last year, when you were planning this year's portfolio, and we did the same podcast last year, the vaccine had just been announced in November of 2020. And we all thought, oh, the end is near. We're going to have this rebound recovery. It's all good and roses into 2021 and bye-bye pandemic once we're all vaccinated and good times are coming. And
That's
they
right.
were. But now here we stand like another year later. A lot of us are going to get this booster thing. We do have other things that can combat the various variants on coronavirus, like the Pfizer pill and Merck has a pill. We have other treatments. This is all good. A lot of people have been vaccinated, but I feel like your job is a little tougher this year than next year. Is that how you're looking at it?
Yes, it is. And I think the pandemic, we have kind of gotten used to it, Tracy. It's becoming endemic to our lives. We all have the vaccines and the boosters, and then there are the breakouts, and now we have the medicines. But it appears that it'll be in our lives for some time, definitely through 2022, maybe longer. But the bigger kind of curveball in 2022 is the change on the Fed side.
Okay.
And these inflection points in monetary policy are always difficult for investors because the Fed is so central to how the market has done and will continue to do. So how fast it tapers, when the first rate hikes start, will have a big impact on how the market does as a whole, which sectors and industries will do, and that's complicated. It's always complicated to have 10 stocks for a whole calendar year, but I feel this year has extra layers of complexity.
Yeah. And do the margin pressures and the supply chain issues play into that too, the inflationary pressures?
Absolutely. So the Fed question is closely tied to the inflation question. And the inflation question directly gets into the what you pointed out, margins and supply chains and all of the logistical issues. We heard today about the wholesale inflation numbers were so high, and that goes directly into the cost of goods sold in the context of the typical company's income statement. So margins are a big deal. We want to be in companies that have pricing power. We don't want to have companies that have to take prices as they are and have so competitive a marketplace where they can't pass those on to the end consumer, and then it ends up affecting their margins. To some extent, most companies will have to bear some margin pressures. So, in terms of the selection of stocks, you want to have stocks and companies that have pricing power, that have some barriers to entry, uh, that have the ability to pass the higher expenses to the end consumers.
So does that mean you may be looking a little more heavily at large cap companies versus the small caps, just because they might have more of a market type dominance?
So I have like off the from the starting list, I have narrowed it down, Tracy.
Okay.
But I'm really struggling with this last 3 dozen or so shortlisted companies. But as a whole, yes, you want to have more stable companies. You're not swinging for the fences anymore. You want profits and cash flows today, not out there 5, 10 years in the future. And you want strong balance sheets. You don't want companies that will suffer in an environment where financial conditions are uncertain or difficult. And I'm always leaning towards companies that are relatively less stretched from a valuation standpoint, though at this stage in the market with everything at record level, it's not easy to find value, as you yourself know.
Yeah.
And if there is value, there's typically a reason for it. So uh, on the whole, large cap gives you safety, but there's plenty on the mid cap side too, where I feel you can have some interesting ideas, and that's what I'm gravitating towards.
So it sounds like with this growth stock pullback that we've seen, that even though some of those names like a Teladoc or those types of names are down 50 to 70% from their recent highs, that those are not the types of names that will be on your list.
I don't think so. Yes, I think that's correct. Though I do like those companies. I think if someone has a holding horizon that's longer than what the top 10 portfolio does. I mean, we have a 1 year is a long period, but it's somewhat artificial in terms of the calendar year restriction. I feel that those types of aspirational growthier long-term plays require holding horizons longer than a year. You would recall that in 2020 we had DocuSign and had a ton of success with that.
Right.
It has made it to my short list, but I don't think it'll be on the final list.
Okay. This year, one of the ones that made your list for 2021 and has been the best performer was Macy's, ticker M. It was up 200% at one point year to date, and now is up about 130% as of December 14th when we're recording this. Still dirt cheap with a PE of 5, PEG of just 0.4. What was your decision making a year ago to put Macy's, which has been battered for many years, in fact, into the portfolio for this year?
I felt that that having exposure to consumer spending would be a winning theme in 2021, and Macy's was just one of the ways in which we played that consumer exposure. We had ULTA as well. Some of our other picks in the portfolio also had a consumer type of theme in them. And specifically to the Macy's pick, I felt that the oversized discount to the broader retail group and to the department stores in the Macy's stock also reflected, in addition to the issues that have been long-standing with Macy's, was this financial question mark, the uncertainty whether the company has the ability to survive as a going concern. There were questions about the company's digital strategy, and uh, and I had a lot more confidence in the digital strategy. My sense was that the long-term plan that management had shared with the street, uh, they were forced by circumstances during the pandemic to really accelerate that and stress test it. We saw that with some of the other companies as well. And it turned out to be a successful call.
Yeah.
Uh, I would like to say that I knew exactly what I was doing, but as is the case with all of these picks, you have to have uh, it's a bet. It's a bet on the outlook for the company, and I felt that consumer will be out in full force, and Macy's, with its footprint and its digital product, will be able to capitalize on that. Many others haven't been able to, and it's good to see that Macy's has done a lot better than like Nordstrom and others.
Yeah. So, what is your take on the consumer heading into 2022? Because they did spend up a storm in 2021, but it appears that they want to continue to do that in 2022. And the job market is recovering strongly now, too. That's usually pretty strong indicator of where the consumer is going when they can get, jobs and pay increases and all of that. So, should we be looking for further consumer exposure into 2022?
I think so. Yes, I think having consumer spending exposure will be one of the winning themes in 2022 and beyond as well. We do not have an economic pullback or downturn on the horizon. You rightly point out the labor market remains very strong. The picture on the wages front remains very positive. And I believe the favorable trends we have been seeing on the consumer side should continue in 2022, Fed or no Fed. So if you have or you have the ability to have consumer spending exposure in the portfolio, I think that should put you ahead in 2022 as well.
Okay. Now, I noticed that this portfolio is outperforming the S&P 500 through November 30th, even without the number one best performing sector in the portfolio, right? It did not have any energy plays.
Yes.
So
Yeah.
what is your outlook on energy, or maybe even just the commodities, which have been pretty hot in general, heading into 2022? And is that an area that people should be looking at?
So energy is underinvested broadly in the marketplace, and I think in 2022 we will be playing catch up on that front. It's useful to have exposure to the energy space. I think in portfolios as a whole, I look at these Zacks Ultimate portfolios that our customers submit to us for our webinars, and I'm surprised as to how few customers really have energy sector exposure. It's hard for us to execute on that in the top 10 portfolio since we have only 10 slots.
Yeah.
But in the to your listeners, I think it's totally a worthwhile sector and industry to have exposure to. And yes, there are these questions about the environment and all of that. and those things will play out, and perhaps they should have exposure to those areas as well. But traditional hydrocarbons-based energy industry is with us for a while. And I think those stocks should do reasonably well in 2022 and beyond.
Okay. What do you think about the semiconductor industry going into 2022? It's been up and down, and right now, some of the big caps in the semis, like NVIDIA, is down 9.3% over the last month. It's finally had basically close to a correction here. Is this an area that people should be looking at because, semis are obviously in strong demand right now?
That's right. So semiconductors is within the broader tech area. Semis is the more cyclical component of tech spending, and I think they have plenty of tailwinds behind them, with the demand for chips remaining strong for quite a while, definitely in 2022. Now, the outlook for business and the outlook for the stocks, they don't always move in sync with each other. A lot of these stocks are red hot, even though, as you mentioned, some of them have pulled back.
Yeah.
If I had to pick, I would look at some of the laggards, perhaps like the Intels of the world. They could give you a bit of income, and the valuations don't appear that stretched as well. The NVIDIAs of the world are a bit too red hot for me, but that's been the performing part of that market. So it's, but that's what I thought at the beginning of 2021 as well. And we saw that was a pretty strong performer this year as well.
What do you think about tech just in general for like this type of portfolio? Because you usually don't go real heavily into tech in the portfolio.
Yes, what we tend to do, Tracy, in the top 10 is we try to find names that are not like top shelf, well-known companies. And so when we have DocuSign, that's when DocuSign is not really a super famous kind of company. And so from an earnings, balance sheet, and cash flow standpoint, I think the winning tech companies would be the large caps, the Adobes of the world, the Ciscos of the world, the Microsofts of the world, and many of these have been strong performers thus far as well.
Yeah.
But the more kind of out in the future profitability outlook companies, I believe, will struggle in an environment where the monetary policy standpoint is a lot more uncertain than it has been in the recent past. So I would be staying away from the DocuSigns and the Teladocs of the world. But companies like Cisco's and Oracle and Adobe and Microsoft and even Google and these other large caps that have a ton of profitability and they should do just fine. I don't see any problem with the with the mega cap tech companies. We don't tend to have that in the top 10, though. We don't usually have the glamorous stocks in the portfolio.
Right. So there won't be any FANG stocks in the top 10.
There won't be any FANG stocks. We have had Facebook the year after it went public, and we had good performance with it. But that was a long time back. We haven't had it since then.
Okay. What about like a lot of these IPOs and SPACs that have come on board? I'm assuming you're staying away from most of those as well for the very reasons you were just laying out, that you want them to have, barriers to entry, the pricing power, profits, good cash flow, all of that. But could one of those sneak in?
I seriously doubt it. The filters are very, very strongly aligned against them seeping through.
Okay.
We're looking for some history of performance. We are looking for balance sheet strength. We are looking for elements that really put them in a good standing in an uncertain operating environment. And these companies that enter the public domain through the back door typically don't qualify in that area. I think that's the super strength and momentum on the SPAC side is perhaps the high water mark of the extremely bullish market we have had. Going forward, I sense it'll be a lot more selective, and the performance will be for companies that really have solid business plans and good products and services. So I could be wrong, but that's how I look at the outlook currently.
Okay. When you're screening initially for these stocks, do you use the Zacks rank or the Zacks style score or any of those kind of like Zacksy things to do an initial screen, or do those not matter because like the rank is such a short-term recommendation that it's not really a factor?
It is part of the screen. There's other financial metrics as well. I do stay away from ranks 4s and 5s.
Okay.
A stock that may be rank 3, but has been a rank 1 and 2 is perfectly fine too. If a stock goes to a 4 or 5 after the portfolio comes out, that's not a reason typically for us to get out of it, but we keep an eye on the rank and the style scores, and the style scores are particularly useful because they capture so many elements of a company's financial strength, like the value score, the momentum score, the growth score, and that's particularly useful. Yeah, so we do include those elements in the initial screening process.
Okay. What else should we know about what it is that, you're looking for next year? Because
so it's a blend. It's a blend of top down, meaning you decide which sectors and industries you want exposure to.
okay.
And then you have a bottom up approach of looking at the companies, at their financial statements, at their company presentations, reading their transcripts, getting a sense of what the analysts are saying about the outlook. And so marrying those two elements, top down and bottom up, in finding the best stocks to play the macro outlook you have for the economy, for the sectors, and for the industries. And it's more of an art than science. It has obviously a high degree of uncertainty. We have been reasonably successful in recent years, but we have had bad years as well. So you have to approach the process with a high degree of humility.
And what happens if a stock does drop down to a 5, after the portfolio launches, but it's what I consider a bad 5. Like there is something bad going on there. Will you remove that stock, put a new one in, or just have 9 stocks, or do you leave it in there? How does that work?
We always keep 10 stocks. So if we do make a change during the year, we will replace it with another stock. Just simply a stock dropping to a 4 or a 5 is not sufficient for it to be booted out of the portfolio. If the sense is that the forces that are driving the estimate cuts will persist through the remainder of the year, and you feel that the stock doesn't have a solid reason to bounce back through the holding horizon, then that's sufficient reason to get out of it and get into something that's a better representation for the remainder of the year. We have done 1 or 2 changes in recent years. This year we didn't do any change, but we do retain the the flexibility to make changes during the year.
Okay. Well, I'm super excited to see what's going to be in this next year's portfolio.
That's right.
There are a lot of things up in the air, and we're actually recording this before the Fed's press release and statement on their recent meeting, so that should maybe or maybe not be helpful to whatever you're going to pick for the finalists in the top 10. But remember, for all of you out there, if you want to get the top 10, you can get it in the first week of January. You can just go to Zacks.com and you'll see it, ads on there for our top 10 portfolio. It's always super fun, and it's nice to start off the new year with some new stock picks, and always like very hopeful to start off the new year.
Sure.
And given what happened this year, could be another fun one. But let me recap some of the tickers we did talk about on this episode. So Macy's is in this year's top 10, ticker M, as is ULTA, ticker ULTA. Both were very good performers on the retail side, but Macy's is the best performer in this year's top 10. There was DocuSign in last year's portfolio, the 2020. So you dodged a bullet on that one, Sheraz, for this year.
That's right.
Ticker DOCU, I think that's DocuSign.
That's right.
And then we talked briefly about some of these other like big cap names. We know mostly what those tickers are, but NVIDIA, NVDA, mentioned Microsoft, MSFT, Cisco, CSCO, Intel, INTC, and I guess that's kind of it. We're keeping it kind of quiet about what's going to happen with this portfolio. But again, it's always our most fun of the year, and we're all waiting to see what's going to be in this year's top 10 and how things will develop heading into next year. It's been a good year for stock investors here in 2021, and everybody's hoping for another year like this year for next year. So let's see what develops. And as always, you want to be sure you're getting all of our podcasts here on the Zacks Market Edge, because when the new year comes, we're going to be talking about a lot of these stocks and what is working. So be sure to get our podcast on Apple. We're on Apple Podcasts. We're on Spotify. We're on Amazon Music. We're, of course, on SoundCloud. And you can get all of our podcasts on Zacks.com. We have a podcast link up at the top of the page where you can get all of our great podcasts, including Nina's ETF podcasts and Kevin Cook's great ones on the money issues and the psychology of stocks and investing. So make sure you get all of our podcasts, and I'll see you again next year on the Zacks Market Edge.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.